Welcome to Meridian, Thailand. Picture it. Paradise found. Luxury towers scraping the sky. Beaches packed. The official line. Recovery. Full steam ahead.
Uh-huh. But you peel back just one layer of that shiny veneer and what's lurking underneath.
A financial time bomb. Seriously ticking. Two Thailands. Two economies. Tearing the country right down the middle.
It's more than just a paradox. It's a massive gamble. A conscious bet by the government on tourism, on foreign investment, thinking they can ride that wave forever.
But it's creating this hollow recovery. Glossy on the outside.
But rotting from within, that's the terrifying part.
Exactly. And you have a front row seat. Today, we're slicing through the headlines. We're laying bare the conflict, the hard numbers, the high-stakes thriller playing out right now.
Forget the travel brochures for a moment. This is the real story.
Let's start with that dazzling illusion. The gilded facade, from the outside. Thailand looks like it's on fire. The government's gone all in on tourism. They're talking 40 million visitors targeted for 2025.
40 million, that's a huge number.
Huge. And they're making it easy. 60 days, visa-free for, 93 countries now? Plus that new Destination Thailand visa for digital nomads. They really want people in. And it looks like it's working, doesn't it? The big hotel groups, Minor International, Asset World Core, their Q1 2025 results were, stellar. Occupancy up. Room rates high. They're making bank.
Okay, so tourism is booming. Check.
But it's not just tourism. Foreign direct investment, FDI, it's exploding. The Board of Investment, the BOI, they're dangling some serious carrots.
Like what?
How about up to 13 years free of corporate income tax? 100% foreign ownership in high-tech sectors. It's incredibly aggressive.
Wow, okay, 13 years tax-free is significant.
You bet. And the big names are biting. TikTok, AWS, Google, all setting up huge data centers. EV manufacturing, advanced electronics, FDI hit a 10-year high last year.
So the foreign money is definitely flowing in.
And look at luxury property. Phuket, Bangkok. Developers like Sansiri launching projects worth over 10 billion baht aimed squarely at rich foreigners, UHNWIs. Prices jumping 10–15% a year in some spots.
Looks like a runaway train, right?
It does look like that from that angle. But that right there is the gilded facade. Because the moment you shift your focus just slightly to the average Thai person, that shine vanishes fast.
Okay, so peel it back for us. What's really happening?
Well, while those luxury condos fly off the shelves, consumer confidence for most Thais, it's tanked, down to a 27-month low, 4 straight months falling.
4 months. Why?
Simple. Incomes aren't growing, but the cost of living is brutal. People are genuinely struggling just to get by. This isn't some, minor dip. It's a crisis brewing quietly.
And you see that in spending.
Absolutely. Private consumption growth slowed to just 2.6% in Q1. But here's the kicker, the detail that tells the real story. Forget the headline retail numbers. Look at durable goods. Cars.
What about cars? People aren't buying them. The auto sector is in a deep, deep slump. Defaults on car loans are soaring. So high, in fact, that banks are rejecting new loan applications. Get this, at rates up to 70%.
70% rejection rate. That's practically a shutdown.
It's a freeze. 7 out of 10 people trying to buy a car on finance are being told no. That tells you everything about middle-class distress.
So if they're not buying cars, what about the businesses that serve the local market, the SMEs?
They're getting hammered. Small and medium enterprises, the supposed backbone, more than 100 are closing their doors every single month.
Another month.
Yes, they're caught in this awful vice. No cash flow, rising costs, imports flooding in, and their customers aren't spending. Even agriculture, employing millions, is drowning in debt.
It sounds like 2 completely different economies.
It is 2 different economies. You've got foreign money flooding into Bangkok, Phuket, inflating prices for condos, fancy restaurants, great for a tiny slice of the population. But everywhere else, debt-laden households, purchasing power collapsing, deflation even on everyday items.
So stark inequality.
It's more than just inequality, though. It's engineered fragility. The success of the few, fueled by foreign capital, is actively weakening the foundations for the many. It's almost like a classic case of Dutch disease.
Explain that a bit.
Well, the booming external sectors, tourism, FDI, drive up the value of the Thai baht. That sounds good, maybe, but it makes everything else. Thailand produces agriculture, traditional manufactured goods, more expensive, less competitive globally. It hollows out the rest of the productive economy.
So the focus on the glittering parts actually damages the core.
Precisely. One part shines, the other part rots. And that rot is fueled by something enormous.
Yet, let's talk about the elephant in the room, the debt mountain. End of 2024, household debt hit 16.4 trillion baht.
16.4 trillion. It's hard to even picture.
The debt to GDP ratio was 88.4%. It dipped slightly to 87.4% in Q1 2025. But hold on. That wasn't because people paid off debt. It's just because the GDP number went up a bit.
So the actual debt load hasn't shrunk?
Not really.
Yeah.
And that 87% figure is one of the highest in Asia. Way over the 80% danger threshold the Bank for International Settlements flags. It's a massive anchor dragging down the whole economy.
And the type of debt makes it even worse, doesn't it?
Exactly. It's not mostly mortgages, debt that might build an asset. A huge chunk, maybe 28% or so, is just non-productive consumer credit.
Personal loans, credit cards.
Right. High interest stuff. For loads of Thais, over half their monthly income is just gone straight to servicing these debts. Imagine living like that.
Half your income just vanishing on interest payments. It's unsustainable.
And then there's the shadow economy, the loan sharks, unregulated, predatory. Estimates suggest they add another 10 to 20% of GDP onto the hidden debt pile.
With terrifying interest rates.
Astronomical. Reports of up to 240% a year. It's absolutely predatory.
And this isn't just numbers on a page. This casts a really dark shadow over society. You hear stories. Families struggling for basics after the debt payments go out. It's been linked to rising crime, even, tragically, a rise in suicides. Echoes of the 1997 crisis.
Horrifying.
Wow.
And the long-term impact.
It's profound. This constant financial pressure, the high cost of living, it's hitting demographics. Couples are delaying marriage, delaying having kids. That's a ticking time bomb for the future workforce, for economic vitality down the road.
And the formal banks aren't helping.
Well, as credit tightens in the formal system, remember that 70% auto loan rejection.
Yeah.
Where do people go? They get pushed towards those predatory lenders. And look at the NPLs, the non-performing loans. They're particularly high among young adults. 25 to 29, you're crippling a generation's financial future right from the start.
So what's the government actually doing about this mountain? We hear about programs like Kun Su, Rao Tui, You Fight, We Help for Restructuring, Bank of Thailand guidelines on responsible lending, even talk of bigger things, right, like NPL buybacks, debt haircuts.
There's talk, yes, and some initiatives. But analysts are deeply skeptical. The Thailand Development Research Institute, the IMF, they basically say these are sticking plasters, treating symptoms, not the disease.
How so?
Well, things like blanket debt relief create moral hazard. If you bail everyone out, what's the incentive to borrow responsibly next time? And the IMF warns that just rolling over bad debt, pretending it's okay, actually makes things worse and uses up public money that should be going into real long-term fixes, like education, infrastructure, making SMEs truly competitive.
So Band-Aids on a hemorrhage, essentially.
Pretty much. While the core problem just keeps festering.
Which brings us to the fracture point, the banks themselves. The latest Bank of Thailand report, Q1 2025. It doesn't look good, does it? Gross NPLs are up over 548 billion baht. The overall NPL ratio climbing to 2.90%.
That 2.90% is worrying, but the real alarm bell is where those bad loans are concentrated. It's not the big corporate loans, those seem okay for now. The poison is spreading through the domestic economy. Loans to SMEs. The NPL rate there is a perilous 7.35%.
7.35, wow. Nearly 1 in 13 SME loans is bad.
Exactly. And consumer loans aren't much better. Auto loans, nearly 3% NPLs. Credit cards, over 3%.
Yeah.
Even mortgages are showing strain at 3.35%, especially in the affordable housing segment.
So you got this weird situation. Banks holding relatively safe big corporate debt on one side, and this increasingly toxic pile of SME and consumer debt on the other. You called it a barbell risk structure.
That's right. It creates inherent instability. Now, the Bank of Thailand officially says the system's resilient. Strong capital, high provisions, plenty of liquidity. That's the official line. But external rating agencies are starting to sound warnings. Fitch is holding a stable outlook on the sovereign debt. Okay, but Moody's. They shifted the outlook for several major Thai banks to negative just mid-last year. S&P also notes high leverage as a vulnerability. These aren't panic buttons, but they're definite yellow flags.
Okay, yellow flags noted. But didn't the banks report higher profits in Q1, like a 5% jump?
Ah, yes. The profit figures. Highly misleading. You have to look how they made that profit. It wasn't from their core business, lending money. Net interest income actually fell.
So where did the profit come from?
Volatile stuff. Non-interest income, gains on investments, cutting costs, things that aren't sustainable, you know? It masks the fact that the actual health of their lending business is getting worse. It's like putting lipstick on a pig. Looks okay on the surface, but
Okay, got it. So the banks are looking shaky underneath. How does this rot spread? How does the domestic crisis infect the whole system? This is where it gets scary, right? The contagion pathways.
Right. Path number one is the most direct. The credit crunch spiral. Bad loans go up, banks get nervous, they stop lending, or make it much harder. We're already seeing lending contract for 3 quarters now, if that gets worse. Even healthy companies, the exporters, the FDI-driven ones, get starved of the cash they need to operate. That chokes the good part of the economy.
Okay, that's direct damage. What else?
Path two, fiscal contagion. If things get bad enough that banks start failing, what happens? The government probably has to step in. Bailouts, that costs a fortune. It blows up public debt, maybe past the 70% of GDP danger ceiling. That risks Thailand's credit rating getting downgraded, making it more expensive for the entire country to borrow money. A vicious cycle.
And the third path.
Path three, investor confidence shock. Remember, Thailand's whole growth plan hinges on attracting that foreign money, that FDI. If there's a domestic banking crisis, forget it. Thailand's image as a stable place to invest shatters. You could see capital flight money rushing out the bat, collapsing, FDI drying up overnight. And given the, let's say, sometimes volatile political situation, a shock like that could be utterly catastrophic.
So a credit crunch, a government debt crisis, or a foreign investor panic. 3 ways the domestic bomb could take down the whole building.
Exactly. The stakes are incredibly high.
Now, let's pull the lens back again. Thailand isn't operating in a vacuum. There's this fierce regional competition, right? Especially with neighbors like Singapore and Malaysia.
Absolutely. It's a constant battle for investment, for talent.
Look at Singapore. Kind of the opposite model, isn't it? High cost, but aiming for high-value innovation. Quality over quantity. They pour money into R&D, into skills training like Skills Future. A magnet for big multinational HQs.
Definitely a different strategy, but it comes with its own problems.
Right. Singapore is incredibly expensive. Rent, salaries. The cost of doing business is sky high. That survey you mentioned found loads of European firms thinking about moving staff out because of costs, and Singaporeans themselves. Cost of living is their #1 worry. They're even talking about brain drain.
And the government's reaction. They've tightened up on foreign talent, raised the minimum salaries for work passes, brought in that points-based system, Compass.
Which has an interesting side effect, right? It sort of hollows out the middle, makes it tougher for mid-sized companies, mid-level professionals.
Precisely. It creates an opening that Malaysia, for one, is trying very hard to exploit.
Ah, the Malaysian alternative, the cost-competitive challenger.
Exactly. Malaysia's pitch is, come here, we offer great value, lower cost, and we'll give you aggressive tax breaks. Their latest budget, the new investment incentive framework, is all about attracting digital and AI businesses.
And that Johor Singapore Special Economic Zone, the JSSEZ, that sounds like a direct challenge.
It absolutely is. Offering a 5% corporate tax rate for up to 15 years. A flat 15% income tax for skilled workers. That's designed specifically to pull businesses and talent across the causeway from Singapore.
Though, ironically, Malaysia has its own brain drain to Singapore, right? Skilled Malaysians seeking higher salaries there.
It's a complex two-way street, definitely. A real push and pull dynamic.
So you've got this push from Singapore, high costs, tighter visas, and the pull from Malaysia and Thailand offering cost advantages and incentives. That Jetro poll finding almost a third of Japanese firms in Singapore looking to move functions elsewhere is pretty telling.
Very telling. Companies like Sakata Inc.'s already shifted their regional HQ to Malaysia.
So how does Thailand fit into this battle? What's its specific pitch against Malaysia?
Thailand's offering is that blend. Lower operational costs than Singapore, yes. Those BOI incentives, the long tax holidays we talked about, and crucially, access to a larger domestic market than Malaysia or Singapore. It's competing hard for that hollowed-out middle that's finding Singapore too expensive or difficult.
But the strategy hinges entirely on Thailand remaining attractive, right? If that domestic debt bomb goes off.
Poof. Its attractiveness evaporates. You can't be a stable regional hub if your own house is collapsing. You end up with no strong domestic economy and no strong FDI pillar. The worst of both worlds.
And this incentive war, is it sustainable? A race to the bottom on taxes?
That's a real risk, especially for Thailand, already carrying so much debt. Giving away tax revenue for years might attract investment short-term, but what about long-term fiscal health? And then layer on the geopolitics. U.S.-China tensions, potential U.S. export curbs on AI chips to Thailand and Malaysia. It just highlights how fragile a model built purely on external factors can be.
Relying on forces you can't control. Risky.
So, looking ahead, what happens? I see, realistically, 3 main scenarios playing out for Thailand. Scenario 1, the most likely perhaps, is muddling through.
Just carrying on.
Basically, the two-track economy continues. Tourism and FDI keep the lights on, preventing total collapse, but the government sticks to short-term fixes, never tackles the deep debt and structural problems. The result, a potential lost decade. Low growth, rising inequality, the average person just stagnates even while the luxury sector booms. A slow, grinding decline.
Okay, that's grim but plausible.
Yeah.
What's scenario 2? The nightmare.
Scenario 2 is the domestic implosion. Medium probability, but devastating if it happens. Some trigger a global recession, a sudden spike in interest rates, maybe a big political shock pushes the system over the edge. Mass defaults. Banks wobble or fail, credit freezes completely, capital flees the country, the bat crashes. The government has to step in with a massive, costly bailout, risking a sovereign downgrade. Deep, painful recession. The hollow recovery is exposed for what it was.
Terrifying. Is there any way out?
Yeah.
Any optimistic path?
There is. Scenario 3. The structural pivot. Low probability, unfortunately, because it's hard. It requires real political courage.
What does it involve?
It involves policymakers finally admitting the current path is unsustainable. They implement real debt resolution, not just kicking the can. That means things like an efficient, fair, personal bankruptcy process, actually enforcing responsible lending rules like debt service to income caps, and targeted debt relief for the truly vulnerable, not blanket giveaways.
And beyond debt.
A major shift in government spending, away from short-term handouts towards long-term investment in Thailand's own productive capacity, education, skills, helping SMEs truly innovate, modernizing agriculture, rebalancing the whole economy towards more sustainable, inclusive growth. It's the right path, but it's politically tough.
Difficult choices. Okay, so given these scenarios, what should investors be thinking if you're looking at Thailand now?
Extreme caution is the word, especially in the financial sector. You absolutely have to dig deeper than the headline numbers. Which banks are heavily exposed to those risky domestic consumer and SME loans, which have stronger buffers from corporate or FDI-related business? That Moody's negative outlook on some big banks, treat that as a serious warning.
What about real estate? That booming luxury market?
It's completely bifurcated. Yes, there might be money to be made in foreign-driven luxury spots like Phuket, but no, it's a high-risk bet, totally dependent on foreign sentiment and capital continuing to flow in. The domestic mass market, residential, commercial, avoid it. Demand is weak, NPLs are high, too risky.
And consumer stocks?
Retail. Steer clear of anything relying on broad domestic spending power. It just isn't there for most people. The only pockets of resilience might be at the very high-end luxury goods for tourists and the elite, or at the very low-end basic staples that people have to buy even when squeezed.
Manufacturing, exports.
It's mixed. The sectors boosted by FDI EVs, advanced electronics look like winners, potentially, but they carry geopolitical risk, as we discussed. Traditional exporters. They face headwinds from that potentially overvalued bat and the fact that they just aren't the government's priority right now. Which brings us back to what Thailand needs to do, what policymakers must confront.
The recommendations. Lay them out.
First, acknowledge systemic risk. Drop the everything is awesome recovery narrative.
Right.
Be honest publicly about the scale of the household debt threat and the hollowness for many. That's step 1. Honesty.
Step 2.
Implement a coordinated debt resolution framework. Seriously, go beyond the piecemeal stuff. Listen to the IMF. Create an efficient, socially acceptable way for people to go through personal bankruptcy and get rehabilitated. Enforce responsible lending, make DSTI ratios mandatory for new loans, and make debt relief targeted and means-tested, not just blanket handouts that create moral hazard.
Makes sense.
What else? Third, rebalance national growth drivers. This is crucial. Shift government money and focus. Less on short-term stimulus, like digital wallets, more on long-term investment in Thailand's own people and businesses. Education, SME support, making farming more productive and sustainable. Build from the inside out, not just relying on the outside in.
And finally,
strengthen financial regulation. Give the Bank of Thailand the tools and the mandate to manage these risks proactively. Counter cyclical capital buffers, systemic risk buffers. Prepare the financial system to actually withstand the fallout when, inevitably, this debt overhang has to be properly dealt with.
right, you can't just ignore it forever. So there you have it, a nation really walking a tightrope. The data paints this picture. High stakes, thrilling, almost like a financial drama unfolding. A huge bet being placed while this time bomb ticks away underneath.
It really poses the question, doesn't it? If you were running Thailand right now, what would you do? Keep doubling down on the foreign money gamble, hoping it pays off forever? Or would you find the courage to turn inwards and deal with the rot before it brings the whole structure down?
The clock is ticking. This isn't just some abstract economic debate. It's real lives, a real nation at a potential turning point. If you found this gripping, do us a favor, smash that like button, hit subscribe. Join us here on Meridian for more insights that cut through the noise.
And don't miss our next episode. We'll be tackling another urgent global challenge. See you then.
If you want more no-nonsense stories about power, money, and the systems behind them, subscribe to Meridian Channel.